The Straits Times Index has been breaking all-time highs recently after being stuck in the lost decade for such a long time.
It's been 84 years.
Okay fine, it's not 84 years, but it still took STI a whopping 18 years to recover back to its 2007 peak. And now, after nearly 2 decades, it is finally back. So what's driving this recent rally? How sustainable is it? And more importantly, is the STI finally not a terrible index? Let's find out in this video. Since the end of last year, many analysts were already calling this rally. Macquarie, for instance, forecasted STI to hit 4,000 points in 2025. RHB wasn't too far off either, with a target of 3,940. DBS had a similar price target at first, before getting even more bullish in March and raising their price target to 4,080, only to chicken out during the April correction and slash it down to 3,855. Same for UOB Kay Hian, who was bullish at the start and predicted STI to hit 4,115 points, but later revised it down to 3,720. Whatever the price target is, the STI outperformed the S&P 500 big time. And that's not even accounting for currency depreciation. In celebration of SG60, Moomoo SG is having an attractive promotion. From June 30th to September 7th, you get to trade in the Singapore shares in ETFs with zero commission fees if you register to the SG stock trading competition. Not only that, every 2 weeks, winners will get to share $20,000 in trading coupons if you hit the competition conditions. Terms and conditions apply. And if you beat the STI index, you will score an extra 1,000 Moomoo points, which you can then redeem for some exciting prizes. You can use Moomoo's free tools to find your investment ideas. For example, Moomoo offers dividend ranking feature for Singapore stocks. If you are a fan of high dividend investing, you can quickly find high dividend stocks through this list. You can also use Moomoo AI to find investment opportunities suited for you. Moomoo AI is powered by Moomoo's exclusive database and market news. You can ask any questions about investing. For example, you can directly ask, what are the top 5 stocks for the second half of the year? Then see which stocks the AI says to watch. New users who sign up to Moomoo SG will get to earn up to $1,120 worth of welcome rewards when you fulfill the terms and conditions. This includes a $20 worth of Nvidia share. Plus, enjoy zero commission for US, Hong Kong and Singapore stock trading, as well as zero commission trades on US options every month for up to 100 contracts. For more details of the promotions, do refer to the link promotion page in the description below. So then, what is driving the fantastic returns of the terrible STI? Most people would probably point to the banks, and they are not wrong. The 3 local banks, DBS, OCBC and UOB, make up close to 50% of the entire STI. And over the past 1 year, the banks have delivered strong returns. DBS surged by nearly 23%, hitting a new all-time high. OCBC rose around 12%, while UOB gained about 10.5%. This was all thanks to interest rates staying higher for longer, which helped boost net interest margins. The rise of family offices setting up in Singapore, which fueled demand for private banking and wealth management services, and of course, the resilient fundamentals of Singapore, such as low unemployment rates and a stable geopolitical climate, which positions Singapore as a safe haven for global capital. But that's actually just part of the story, because here's the truth. With the exception of DBS, both UOB and OCBC are actually underperforming the STI. This tells us that the STI's recent rally wasn't just bank-driven, but rather it was a broad-based rally, driven by the strong performance of many other companies. For example, ST Engineering surged by 90%, Hong Kong Land jumped 85%, Singapore Exchange climbed 60%, even Singtel, which was once thought to be a boring ex-growth company, rose by 33%. So, what's driving many of these names to go up? One big driver has been the market reforms and capital management initiatives. Many of these companies have been actively restructuring themselves, moving away from outdated business models and unlocking value. Take Singtel for example. For the longest time, its stock price was going nowhere. It was dragged down by declining legacy revenues, underperforming regional associates, and the reputation as a bloated, boring telco. But in 2021, under the new group CEO, things started to change. Singtel kicked off a major strategic reset, shifting focus to digital services, data centers, and infrastructure monetization. They started divesting non-core businesses, forming strategic partnerships, while returning capital to shareholders through special dividends. And the results are finally showing. In the latest earnings, Singtel reported a 9% rise in profit and declared a higher dividend. Meanwhile, Keppel and CapitaLand Investment have been moving from asset-heavy models to more asset-light, capital-efficient strategies, focusing on fee-based income, services, and fund management. This shift not only improves returns on equity, but also appeals to investors looking for growth with lower capital intensity. At the same time, Hong Kong Land has been buying back shares while launching a strategic review to pivot more heavily into investment properties. Beyond corporate reforms, several companies also benefited from strong business performance. ST Engineering soared on the back of booming demand in defense and aerospace contracts. UOL Group rose on the back of new project launches and successful land tenders. Even Keppel DC REIT held up surprisingly well, despite the high interest rate environment. This was all thanks to its exposure to digital infrastructure. So then, given that STI has performed so well recently, can it continue to do well from here? First off, the banks are expected to face earnings declines amid falling interest rates and slower loan growth. However, they are likely to remain resilient. That's because they've reduced the reliance on net interest income over the years, and they've been growing other income streams like wealth management and fee income. Meanwhile, lower interest rates are expected to benefit the property sector. REITs, which have been under pressure for the past few years, may finally see a turnaround as borrowing costs fall and investor sentiment improves. And of course, many of the other names such as Keppel, Singtel, and ST Engineering have solid catalysts ahead. On a bigger scale, MAS will also be planning to revitalize the local stock market. This includes allocating an initial $5 billion fund to attract more institutional investors and fund managers into Singapore equities. There's also a renewed focus on attracting higher quality IPOs and boosting overall market liquidity. Further updates are expected in Q3 2025. But even before the details are out, the market is already pricing in optimism. Despite the recent rally, STI still offers a solid dividend yield of 4.2%. This is attractive, especially when compared to many global benchmarks. However, in terms of valuation, it's currently trading at a PE ratio of around 14.6, which is higher than its historical 10-year average of 13. This suggests that the index may be slightly overvalued right now. But then, why are we even looking at the STI at all? Isn't it a terrible index as compared to the almighty S&P 500? No matter how you look at it, the S&P 500 has clearly outperformed the STI by a wide margin. It's like comparing Joseph Schooling to Joseph, who is still schooling. Well, that's only partially true. If you factor in the dividends, the STI has delivered annualized returns of around 7% versus about 10% for the S&P 500. Still lower, but not as jalad as it first looks. And if you account for the USD depreciating against SGD, the gap narrows even further. But perhaps this probably isn't a fair comparison to begin with. The S&P 500 is a growth-heavy index dominated by tech giants and high-growth companies. The STI, on the other hand, is better known as a defensive income-generating index made up of mature sectors like banking, real estate, and utilities. It's like judging a fish by its ability to fly. STI was never designed to sprint like the S&P 500. Instead, its strength lies in its stability and dividends. So, here are a few unique advantages that the STI offers that the S&P 500 doesn't. First, since the STI is denominated in SGD, Singapore-based investors don't have to worry about currency fluctuations eating into the returns. And for foreign investors, the Singapore dollar has been a stable and gradually appreciating currency thus far, especially compared to regional peers and even the US dollar over long periods. So you benefit not just from index growth, but also from potential capital appreciation of the Singapore dollar. Second, unlike US investments where there's a 30% dividend withholding tax and up to 40% estate tax for foreign investors, Singapore stocks carry no such tax burdens. What you earn is yours to keep. Third, STI companies tend to offer attractive dividend yields. In fact, STI dividend yields are among the highest in the APAC region. At the same time, the STI tends to be less volatile, mainly due to its heavy weighting in banks and low exposure to more volatile sectors like technology. This combination makes it especially appealing for income investors who who value steady dividends and prefer lower volatility. And of course, Singapore enjoys a stable political environment and pro-business policies, which offer investors an added layer of long-term confidence. In short, after nearly 2 decades of being stuck, the STI's recent rally shows that it's finally back in the game. While it may not match the explosive growth of the S&P 500, the STI's strength lies in its stability, consistent dividends, and resilience through market cycles. For Singapore-based investors, the STI offers many unique advantages that the S&P 500 doesn't. Plus, its defensive nature and attractive use make it ideal for those seeking income with lower volatility. So, is the STI finally not a terrible index? Probably not. It may not be the fastest sprinter, but it's a reliable marathoner that probably deserves a spot in many portfolios, especially for those who value stability, income, and local exposure. Anyway, that's all for this video. Hope you found this useful. Like, share, and subscribe as I'll be posting new videos every week.